Back, everyone. It's OJ having a solid day wherever you're watching from. Japan's bond market is starting to fracture. But before we dive into this critical breakdown, make sure you check out thoughts and observations there that are often too early or too sensitive for other platforms. Copycats can copy content, but they can't copy the handle. The link is in the description. Also comments, and they help us recognize the real ones. Now let S talk about something that is quietly becoming one of the most important financial stories in the world. Japan's 30-year bond yield has just reached the highest level since these bonds were first introduced. At the same time, the U.S. Federal Reserve has stepped in to support the Japanese yen. Pause on that for a second. The U.S. government is now actively backing the currency of another nation. If this situation becomes the new normal, it points to much deeper weakness in the dollar ahead. This is no longer a "this might happen someday" situation. This is a clear case of it is already happening. Welcome, even though most people are barely paying attention. Japan. For decades, Japan has been treated like background noise in global finance. Slow growth, an aging population, massive debt, and yet nothing ever really seemed to happen. Or at least that's how it looked. But right now, something has changed. And when Japan changes, the effects don't stay contained within Japan. Japan's 30-year government bond yield has moved into territory it hasn't seen since the late 1990s. That may sound technical, but it's a very big deal. At the same time, Japan's total government debt has expanded to roughly 10 trillion. Meanwhile, the Japanese yen has fallen to levels against the US dollar not seen in multiple decades. These aren't random data points. They are connected, and together, they are telling a story investors cannot afford to ignore. Japan is the fourth largest economy in the world. When stress appears there, it doesn't stop politely at the border. It flows through currencies, bond markets, stock markets, and eventually into household finances around the globe. Even if you've never owned a Japanese stock or bond, what's happening there can still impact your portfolio. Many people assume Japan's issues are old news. They've heard about the debt for years. They've heard about low growth, deflation, and demographic decline. So when another Japan headline appears, it's easy to tune it out. But this moment is different. The dynamics have shifted, and the room for mistakes is shrinking. One major reason Japan matters so much globally is what it owns. Japan holds more than $1 trillion worth of U.S. Treasury bonds. That makes it the largest foreign holder of American government debt. If Japan experiences serious financial strain and needs to adjust its balance sheet, that doesn't remain a domestic issue. It directly affects U.S. interest rates, global liquidity, and risk assets everywhere. Let's start with the core problem: Japan's debt. Government debt stands at roughly 10 trillion. Compared to the size of its economy, this is extreme. Japan's debt to GDP ratio is about 260%. In simple terms, the country owes around 2.5 times what its entire economy produces in a year. No other major developed economy is anywhere near this level. Practically speaking, around a quarter of Japan's annual government budget now goes towards servicing debt. Not infrastructure, not education, not healthcare. Just interest payments on money already borrowed. For years, this wasn't seen as a problem because interest rates were near zero. Japan could refinance enormous amounts of debt at almost no cost. It was like having a massive credit card with no interest. But cheap credit never lasts forever. And in Japan's case, that era is coming to an end. As bond yields rise, the cost of managing that 10 trillion in debt rises with them. The higher yields go, the faster the numbers become uncomfortable. Now bring the currency into the picture. The Japanese yen has weakened sharply and is trading near multi-decade lows against the US dollar, hovering around the mid-100s per dollar. This isn't a short-term fluctuation. It's the result of policy decisions. While the US Federal Reserve raised interest rates aggressively to fight inflation, the Bank of Japan kept rates extremely low. That difference creates what's called an interest rate differential. Money flows toward higher returns. If you can earn several percent holding dollars or almost nothing holding yen, the choice is obvious. Capital leaves Japan. That outflow weakens the yen further, and a weaker currency creates a feedback loop. Japan imports a large share of its energy and food. When the yen falls, those imports become more expensive. That raises costs for households and businesses and pushes inflation higher. This puts the Bank of Japan in a corner. Raise rates to support the yen, and you risk blowing up the debt structure and slowing the economy. Keep rates low, and the yen keeps falling while inflation builds. There is no painless option. For most of the last 30 years, Japan's main problem was deflation. Prices barely moved or even declined. Many economists wanted inflation to return. Now it has, but not in a way that fixes Japan's deeper issues. Inflation has been running around 3% on average in recent years. That might sound mild compared to what the US or Europe saw after the pandemic, but for Japan, this is a major shock. The entire system was built on stable prices. Savers held cash because it made sense. There were no meaningful yields elsewhere, and cash didn't lose value. That world is over. Cash is now eroding in value, long-standing habits are being challenged, and policymakers are under pressure to act, even though every option carries risk. This brings us back to the bond market. Rising inflation means the Bank of Japan can no longer justify endless money creation and zero rates. That leads us to the mechanism that held Japan together for decades and is now starting to unwind. For years, the backbone of Japan's system was quantitative easing. Japan didn't just try it, Japan mastered it. For nearly 2 decades, it ran one of the most aggressive bond buying programs in modern history. The government spent far more than it collected in taxes and issued bonds to cover the gap. Instead of letting markets set prices, the Bank of Japan stepped in and bought massive amounts of those bonds by creating money. Over time, the central bank became the bond market. Today, it owns more than half of all outstanding Japanese government bonds. That kept yields artificially low and allowed the government to borrow at almost no cost. But that system only works when inflation is near zero. Once inflation appears, the logic collapses. Since around 2022, the Bank of Japan has slowed its bond purchases and has recently begun shrinking its balance sheet. That means the largest buyer has stepped back and, in some cases, become a seller. When the biggest buyer leaves, prices fall. When prices fall, yields rise. What we're seeing now isn't random, it's the natural result of removing artificial support. Higher yields mean higher debt costs. They crowd out government spending and send stress through banks, pension funds, and insurers loaded with government bonds. There's another pressure many outside Japan underestimate: tourism from mainland China. Chinese tourists were once a major source of revenue. That flow has slowed sharply, not because of health restrictions, but because of geopolitics. Rising tensions between Tokyo and Beijing led Chinese authorities to discourage travel to Japan. The impact was immediate. Visitor numbers fell, hotels discounted rooms, retailers felt the slowdown. Small businesses were hit. This kind of damage doesn't always show up quickly in GDP data, but it hits livelihoods in real time. Then there's demographics. Japan's population is shrinking and aging fast. The population peaked around 2010 and has been declining since. By mid-century, Japan could lose more than 25 million people. The median age is now close to 50. There are more people over 65 than under 15. The workforce shrinks each year, tax revenue falls, and spending on healthcare and pensions rises. You can't grow out of debt when your workforce is shrinking. The math is brutal. So where does Japan go from here? There are a few paths. One is managed decline, slower growth with a focus on stability and quality of life. Another is immigration reform, which would require major cultural change. A third is automation and robotics, where Japan already leads, but progress is gradual. The worst-case scenario is a debt reset driven by rising yields and falling confidence. Most economists see that as unlikely, but not impossible. So why should you care if you don't live in Japan? Because Japan is too large and too connected for its problems to stay isolated. It holds more than $1 trillion in U.S. treasuries. If Japan sells to raise cash, U.S. interest rates rise. That affects mortgages, corporate borrowing, stocks, and spending. A weaker yen also reshapes global trade and currency dynamics. Japan is also a preview: aging populations, shrinking workforces, rising debt. Other countries are heading the same way. Japan shows what slow-motion financial stress looks like before it arrives elsewhere. There are also opportunities. Stress creates mispricing. Some of Japan's strongest companies trade at deep discounts. Major investors are already positioning for stability, not collapse. The big takeaway is simple: no economy is invincible. Japan was once unstoppable. Now it's navigating limits. It likely won't implode, but even a controlled adjustment has global consequences. Bond yields and currencies are early warning signals.